There's some genuine carnage away from tech that no one's been talking about because it's been done rolling and dripping. PepsiCo, that's a good example. It's an excellent company. It's got great growth for a packaged food play and it's tremendous balance sheet, yet it's pulled back 11% from its highs to the point where the stock now yields more than 3%. Hey, guys, it's a snacking company. Don't we snack more at home? Isn't that what people say? General Mills just reported a great quarter and raised its dividend to 3.5% level. It's come down from 66 to 57. People didn't like the quarter. Oh, are you kidding me? The quarter was fine. They raised a dividend. They weren't supposed to do that for another couple quarters. We recently had James Quincy, the CEO of Coca-Cola, on the show, and he told us a very compelling story. The stock yields 3.4%. How about J&J? Another quality defensive name. Also keeps getting blasted, although it bounced a bit today on news that it's starting a gigantic vaccine trial against COVID. These stocks represent real value. I think you can buy some of them tomorrow and then buy more if they go lower. Those you do in stage down. Plus, they have the added advantage of not having any hot money in them whatsoever. So your fellow shareholders aren't going to panic and dump the stocks as they go lower. Now, one more key difference versus 1999 is that we've had weeks where some sectors roll over aggressively, like the recent weakness in PepsiCo, General Mills. And unlike back then, though, bonds are giving you next to no yield. And the Fed chairman just told us that we can expect that to continue, possibly for years. If you want income, well, here you go, okay? These are like bonds that also have the ability to grow. I like to think of it as two great tastes that taste great together. Not bad. Anyway, look, I'm not trying to lull you into a false sense of security here. I'd be wrong. The market's getting pulverized. I think there could be more downside here. We're headed for choppy times as many of the permanently bullish new investors get washed out as they discover that stocks don't always go up. On last night's Off the Charts, the legendary Larry Williams told us to expect turbulence until mid to late October. He's been emphatic that the end of September, where we are now, will be no picnic for the bulls. I recommend legging into the stocks I just mentioned on weakness because they work even if COVID cases keep spiking and the economy slows down, both of which I think is going to happen. The bottom line, I expect this market to stay volatile with a downside bias until more of those overly bullish new investors throw in any towel that they may be holding. We can't know when they'll be done their selling. That's impossible. But we do know when it makes sense to start buying into weakness. The high flyers work down 25% from the top, and the defensives work when they yield north of 3. But when it comes to anything else, you have to be patient because better prices could lurk into the murk.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.